Imagine waking up tomorrow and realizing your digital wallet just made like 40,000 profitable trades while you were asleep.
Right, completely autonomously.
Yeah, no clicking, no authorizing on your phone, just this invisible swarm of software working relentlessly for you.
Working at speeds we literally can't comprehend.
Exactly. And today, we're looking at the massive collision in the financial world that is actually making that possible. Welcome to the deep dive.
Glad to be here. It's an absolutely fascinating topic.
I was looking at the calendar earlier. It's Wednesday, June 10th, 2026. And I was just realizing how incredibly fast this future is creeping up on us.
Oh, it's not creeping anymore. It's sprinting.
Right. So our mission today is to unpack this massive paradigm shift. We're looking at the explosive growth of real-world assets, or RWAs, moving on-chain, and how that heavy machinery is crashing headfirst into the mind-bending rise of the machine economy.
Basically, AI agents using crypto rails.
Exactly. And to do this, we're pulling from a huge stack of sources today. We've got a deep dive interview on the XRPL's recent growth, a massive coin paprika breakdown on asset tokenization, a really visionary conversation between macro expert Raoul Pal and Arpan Nanavati from Beep, plus some technical deep dives into the SUI and Flare networks.
It's a lot of ground to cover.
It is. Okay, let's unpack this. Because we aren't just talking about humans trading tokens anymore. We are looking at an infrastructure race for infinite demand.
Well, and to really grasp the stakes here, I think we have to ground ourselves in the reality of the market right now. By mid-2026, the on-chain RWA market is sitting at roughly a $31 billion reality.
Wow, 31 billion.
Yeah. And this is not the Wild West of crypto from a few years ago. This space is heavily dominated by strict legal structures. So if we want to understand this collision, we have to look at it strictly through the lens of practical utility and execution speed.
Right, because before we can unleash a swarm of AI agents on the global economy, we need to understand what assets they're actually going to be trading, And when I was digging through the recent data on asset tokenization from the sources, the numbers on the XRP Ledger, the XRPL, they completely stopped me in my tracks.
The growth curve there is pretty staggering.
It's a 100x growth curve in just 18 months. I mean, in January 2025, XRPL had about $50 million in RWAs. Today, it's at 5.1 billion. That is a total hockey stick graph.
Yeah, but that kind of hypergrowth, it doesn't happen by accident. It happens because of a very specific targeting strategy.
What do you mean?
Well, if you look at the readiness frameworks, like the coin paprika breakdown we have, what really stands out is what XRPL is entirely avoiding.
Okay.
They are not chasing the highly complex, flashy assets. They aren't going after tokenized commercial real estate or complex private equity vehicles.
Wait, really? Well, I thought putting skyscrapers on the blockchain was supposed to be the holy grail of tokenization.
I mean, it's a massive market, yes.
Yeah.
But think about the sheer legal friction involved there. Tokenizing a skyscraper requires incredibly complex special-purpose vehicles just to manage the equity, the dividend payouts, voting rights. It requires programmable smart contracts that, frankly, can break.
Which you do not want when a skyscraper is involved.
Right. So instead, XRPL is targeting what analysts call the medium to high readiness categories. We're talking about money market funds, commodities, and intraday repo markets.
Okay, hold on. Let me stop you right there. Intraday repo markets. That sounds like the exact kind of Wall Street jargon designed to make my eyes immediately glaze over.
I know, it sounds incredibly dry.
What actually is a repo market, and why does a blockchain even care about it?
Fair point. Let's demystify that a bit.
Yeah.
Think of a repo market like a massive, ultra-short-term pawn shop for global banks.
A pawn shop. Okay, I'm tracking.
Yeah. A bank might need cash for literally just a few hours to balance its books at the end of the day. So it hands over safe assets like U.S. Treasury bonds to another institution as collateral, gets the cash, and then buys the bonds back a few hours later with a tiny bit of interest.
Oh, I see. So it's a repurchase agreement, a repo.
Precisely. And because it happens in hours, meaning it's intraday, the settlement of that trade needs to be incredibly fast and rock solid.
That makes sense.
You don't need a highly complex, programmable smart contract for a pawn shop transaction. You just need to securely move the heavy asset and the cash at the exact same time without anything failing.
Right. And looking at the specific platforms building on this, the sources highlighted this massive real-world example called Just Tokens.
Oh, yeah, they're a perfect example.
They hold about $1.76 billion in tokenized megawatt-hour claims on XRPL, which, from what I gather, are basically energy-backed forward contracts.
Yeah.
So buying the rights to future electricity.
Essentially, yes. A forward contract is just an agreement to buy or sell an asset at a specific price on a future date. Energy producers use them constantly to lock in prices.
Just to manage risk.
Exactly. Again, it is a massive settlement-heavy asset. You also see this with Ondo U.S. Treasuries moving on to XRPL. They're targeting debt and fund units that just need to move securely.
Okay, so XRPL is basically building this highly regulated freight train.
That's a good way to put it.
It takes 3 to 5 seconds to reach finality. The fees are practically zero. And instead of using complex, hackable EVM smart contracts, they use built-in features called multi-purpose tokens, or MPTs.
Right.
But I have a major pushback here. When I read through all this stuff in the sources about centralized custody and regulatory compliance, I kept thinking, if we are just trading representative assets sitting in a traditional vault somewhere, isn't this just traditional finance wearing a crypto wrapper?
Yeah.
Like, where is the actual disruption?
It's probably the most common critique of the entire RWA space, but it misunderstands the core mechanic of how real-world assets actually function. In this space, the legal structure is the dog, and the blockchain is just the tail.
Wait, what do you mean by that?
Well, if you are tokenizing a piece of U.S. corporate debt, you cannot simply bypass the U.S. legal system with code. You just can't.
Right, the SEC wouldn't exactly love that.
No, they wouldn't. The asset class itself dictates the legal wrapper, like a trust or an LLC. That wrapper dictates the regulatory path you have to follow, which then finally determines the type of digital token you're even allowed to use.
Ah, I see. So the blockchain isn't replacing the law, it's just making the accounting of that law hyper-efficient.
Exactly. And the sources highlight how XRPL actually embraces this reality rather than fighting it. They navigate local constraints, like Argentina's strict rules on distribution, by utilizing simple custody receipts.
Which is why the big players are comfortable with it.
Yes. That level of compliance is exactly why massive institutions trust it. XRPL's goal is to handle trillions in daily volume by being legally bulletproof. They're prioritizing practical industrial utility over being a playground for wild, decentralized finance experiments.
Okay, that makes sense for the traditional banks. But here is the massive pivot. If XRPL is essentially building a digital fortress for slow human law, that fortress becomes completely useless when you change.
Oh, entirely useless.
Right. A 3 to 5 second freight train is an absolute miracle if you're trying to settle a massive repo contract between two banks in London and New York. That normally takes days. But what happens when the user isn't a bank at all?
What happens when the user is software?
Exactly. What happens when the user is a piece of autonomous software?
And this is where the entire paradigm flips completely upside down.
I was reading this visionary conversation in our sources between Raoul Pal and Arpan Nanavati. He's the CEO of Beep, an agent infrastructure company. And they introduced this concept called machine GDP, or MGDP.
It's a fascinating concept.
Cal argues something that gave me a genuine moment of pause. He says the total addressable market, the TAM for finance, is no longer limited to the 8 billion human beings on Earth. The TAM is now infinite.
You really have to let that sink in for a second.
Right.
The biggest users of financial networks won't be humans clicking buttons. They will be AI agents. They'll be running arbitrage strategies, managing corporate treasuries, or just constantly paying microcents for cloud compute power 24 hours a day.
It is absolutely staggering. I mean, I want you listening to this to imagine this scenario. Imagine you have 100,000 AI agents working for you.
And they don't sleep.
They don't sleep. They are scanning global markets, finding tiny inefficiencies, making thousands of microtrades every single second. Suddenly, that incredibly efficient 3-second XRPL freight train doesn't look fast anymore. It looks like a massive traffic jam.
If we connect this to the bigger picture from the sources, it's a fundamental architectural conflict. Every piece of traditional finance, and frankly, even the older generations of blockchains, were built for human reaction times.
Right, the time it takes to read a screen.
Exactly. Reading a screen, clicking a mouse, entering a PIN code. But agents do not have eyes or a mouse. They operate at machine speed.
So what does machine speed actually require from a network?
It requires instant sub-second settlement. But even more importantly, it requires parallel processing.
Because they're doing so many things at once.
Yes. If an AI agent has to wait 3 seconds for one trade to settle before it can make its next move, that delay compounds exponentially over millions of actions.
Wow. Because in high-frequency trading, if you're 3 seconds behind, you have already lost the trade to an agent on a faster network. You are dead in the water.
Precisely. XRPL is brilliant for the final immutable settlement of a heavy regulated asset, but it's fundamentally not built to be the execution layer for high-frequency machine-to-machine swarms making 1 million micro decisions a minute.
Okay, so if XRPL can't natively handle this micro-machine explosion, where do all these agents actually go?
Well, that's the big architectural showdown happening right now.
Right. The sources point to 2 radically different networks trying to solve this bottleneck. SUI and the Flare network. Let's start with SUI. The sources talk a lot about its object-centric data model, but honestly, my eyes started crossing a bit when they got into the technical weeds there. Break this down for me.
Sure. So to understand SUI, you have to understand the specific bottleneck it's trying to fix. Most traditional networks, like Ethereum, are account-centric. They use a sequential queue to process data.
Okay, I love a good analogy. Let me try this. It's like a grocery store with only one single checkout line. It doesn't matter if you're buying a single pack of gum or a massive cart full of monthly groceries. You have to wait your turn in the global line.
That is a perfect way to visualize it. Every single transaction must be ordered one after the other in a block. And the network does this to prevent people from spending the same digital dollar twice.
Right, the double spend problem.
Exactly. But SUI changes the architecture completely. Instead of tracking accounts in a global line, it tracks specific independent objects.
So how does that actually fix the checkout line problem?
Going back to your grocery store analogy, SUI essentially gives every single shopper their own personal checkout aisle. Because SUI tracks the specific item being traded, it knows that if your AI agent is trading asset A and my agent is trading asset B, those two transactions have absolutely nothing to do with each other.
Oh, I see. So they don't need to wait in the same line. The network can process both of them at the exact same time without worrying about double spending.
Yes, that is true parallel execution. The network only locks the specific object being traded, not the entire ledger.
That is wild. And the result of that architecture is what the sources call sub-second finality. It clocks in at around 400 milliseconds using their consensus mechanism, as they call mysticeti.
Right.
I mean, 400 milliseconds is literal machine speed.
It is horizontal scalability at its finest. If demand goes up, you just add more hardware, more checkout aisles, and the network keeps churning without slowing down.
Which explains why agent-native platforms like Beep are building their infrastructure on SUI.
Exactly. It is natively designed to handle that infinite swarm we were talking about earlier.
But wait, this brings up a huge question for me. Does XRPL just accept defeat here? Do they just say, fine, SUI, you take the infinite AI economy, we'll just sit over here and be the slow, boring settlement layer?
Not at all. And that is exactly where the second network enters the picture, Flare. Flare acts as what we can call a smart sidecar for XRPL.
Okay, I saw Flare mentioned in the sources, but I got completely lost in the acronyms. They mentioned bridging, EVMs, and something called an FTSO. What does that actually look like in practice? How does it help XRPL?
Let's break it down piece by piece. XRPL lacks the complex programmable smart contracts that AI agents often need to execute their advanced logic.
Because they're just doing basic MPT transfers.
Right. But Flare has them. It runs an Ethereum virtual machine or EVM environment. So they bridge the assets. They take XRP from the XRP Ledger, lock it, and issue a mirrored version on Flare called FXRP.
Okay, so now the asset is sitting on a network with smart contracts. But what about that FTSO thing? What does that do?
That stands for Flare Time Series Oracle, and this is absolutely crucial for agents.
Wait, how does a blockchain actually know what the real-world price of an asset is?
Yeah.
Like, if an AI is trading oil or stocks on a blockchain, the blockchain itself doesn't have a Bloomberg terminal.
No, it doesn't.
Doesn't have eyes to see the real world.
Exactly. And that is famously known as the Oracle problem.
Right.
An Oracle is a system that fetches off-chain data like the real-time price of oil, weather data, or stock prices, and securely feeds it into the blockchain so the smart contract can actually use it to make decisions.
Oh, okay.
So Flare's FTSO is a highly decentralized Oracle built natively into the network. It allows AI agents to make decisions based on verifiable real-world data without trusting a single centralized source.
So Flare essentially gives the XRPL assets a brain and some eyes, but does it actually solve the speed problem?
That is the catch. Currently, it only partially solves it.
Because it's an EVM.
Yes. Because Flare uses an EVM environment, it still inherits that single checkout line problem we talked about earlier. Its blocks take about 1.3 seconds to process.
Which is definitely faster than XRPL's 3 seconds.
Yeah.
But 1.3 seconds is still a total lifetime to an AI agent trying to do high-frequency microtrades.
True. But Flare has a massive technological upgrade on its roadmap designed specifically to fix this. It's a ZK rollup layer 2, specifically a structure called a validium.
Okay, you have to explain that like I'm 5. What is a ZK rollup and how is a validium different?
Sure, think of a ZK rollup like a restaurant tab. If you go to a busy bar with friends, the bartender doesn't run your credit card for every single beer, every appetizer, and every main course separately.
Right, that would be incredibly slow and the credit card fees would be absurd.
Exactly. They bundle it all up and you pay one final bill at the end of the night. A ZK rollup processes thousands of transactions off the main blockchain, does all the complex math, and then submits one tiny cryptographic proof, a mathematical receipt back to the main chain, proving that all the math was correct.
Oh, that's clever.
It is. And a Validium takes this a step further by keeping the heavy transaction data off-chain too, which makes it incredibly cheap and insanely fast.
Oh, wow. So if Flare successfully deploys this Validium, They could take that 1.3-second block time and basically cram tens of thousands of AI microtransactions inside of it.
Yes, it compresses the activity, drastically lowering fees and giving agents the execution speed they actually need. Plus, it adds privacy.
Privacy.
Yeah, the cryptographic proof proves the trades were valid without revealing the specifics. That is massive if your AI agent is running a highly profitable, proprietary trading strategy that you don't want the whole world copying.
Wow. Okay, I need to take a breath and bring this all together. We started this deep dive looking at the staggering growth of real-world assets. Billions of dollars in traditional financial instruments, energy contracts, treasuries, repo agreements being digitized on the XRP Ledger.
Creating this incredibly secure, legally compliant foundation.
Right. And then we introduced the chaos agent, machine GDP. An infinite swarm of AI agents demanding millisecond execution and massive data inputs.
And what's so fascinating is that there isn't one single winner here.
No, the infrastructure is fracturing to meet these entirely different realities. We're firmly living in a multi-chain world. XRPL is the heavy, trusted vault for the big institutional trillions. Subi is the hyperspeed parallel playground where autonomous software can trade freely.
And Flare is sitting there as the bridge, providing the data oracles and the smart contract logic to connect it all.
Which means the financial system is undergoing a fundamental segregation based on the type of user. So what does this all actually mean for you, listening to this right now? Why does it matter to your digital wallet? It means the very definition of money is splitting.
That's a great way to put it.
There is human money, the money that moves at the speed of our clicks, governed by traditional custody receipts and local laws. And then there is machine money, money that moves in fractions of a second, managed entirely by autonomous swarms running on completely different architectural engines.
And that split leaves us with a profound, almost philosophical question to think about.
What's that?
Well, we established earlier that the real-world asset market relies heavily on traditional legal wrappers like trusts and LLCs to function. But what happens to human law when an LLC is 100% owned, funded, and operated by an autonomous AI agent?
Oh my God, I can't even imagine. If an AI agent running on Sui is executing complex corporate contracts and moving capital across borders at 400 milliseconds, who is legally responsible if something goes wrong?
That is the billion-dollar question. How does a human court of law regulate a machine entity that can conduct an entire lifetime of financial transactions faster than the judge can physically blink?
That is genuinely staggering to think about. Because if these projections are right, you won't just have one of those agents. You might have 100,000 of them, invisibly managing your financial life while you sleep. Thank you so much for taking the time to join us on this deep dive. Keep questioning the infrastructure that's currently running our future, because the speed limit of money has officially been broken.